You know, in the world of investing, if there's one thing you can count on, it's uncertainty. So today, we're going to open up the Investor's Toolkit and look at the mathematical tools we use to speak the language of that uncertainty. These are the probability distributions that really help us navigate the unknown and hopefully make smarter decisions.
I mean, think about it for a second. What's the stock's return going to be next year? What about its next quarterly earnings? Which way are interest rates headed? We just don't know for sure. In statistics, we call these things random variables. And figuring out how to describe their range of possibilities, well, that's the absolute first step to making any sense of the market.
Okay, so first things first, we need to get a handle on exactly what we're dealing with. Let's break down this whole idea of a random variable and the two basic forms it can take.
To put it super simply, a random variable is just any number we don't know for sure yet. And let's be honest, that covers just about everything that matters when you're looking at an investment's future, right? The key isn't to pretend we know the exact outcome. No, the real trick is to describe all the possibilities. That's where savvy investors start to get an edge.
Now, this uncertainty kind of comes in two main flavors. On one hand, you have discrete variables. This is stuff you can literally count, like a stock price moving up or down in 1-cent jumps. But then you have continuous variables, like a rate of return, where you can just keep adding decimal points forever. It could be 1.25% or 1.251 or 1.2511. You get the idea. Knowing which type you're dealing with is absolutely crucial because it tells you which tool from our kit you need to pull out.
All right, so we've got our basic terms down. Let's start building up our toolkit. We're going to begin with a really powerful model that's designed for the simplest kind of uncertainty there is, when something can only go one of two ways.
So say hello to the binomial distribution. This is your go-to model anytime you can frame a problem in binary terms. Is this trade going to make money or lose money? Does the stock price go up or does it go down? If we can define a success and a failure and then repeat that event, the binomial distribution lets us figure out the probability of getting a certain number of those successes.
And here's where it gets really cool in finance. One of its most important uses is building what we call a binomial tree. It's simple, really. You start with today's stock price. Then, in the next period, it can only go one of two ways, up or down. From each of those two new spots, it branches out again, up or down. You repeat this a few times, and suddenly you've built this entire tree that maps out all the possible future paths for the stock price. This simple logic is actually the foundation for pricing really complex options.
Okay, that up or down model is pretty slick. But let's be real, most things in finance aren't that black and white. So now we're going to move on to the most famous, the most widely used distribution in all of finance, one that models a whole continuous range of possibilities. You know what I'm talking about, the bell curve.
Of course, it's the normal distribution. You've seen it everywhere. This thing is the absolute workhorse of modern portfolio theory and risk management. Its predictable shape and its properties make it an incredibly powerful tool for modeling things like asset returns.
And the reason it's so powerful, it's actually pretty simple. It's perfectly symmetric, which just means the chance of a good surprise is exactly the same as the chance of a bad one. And get this, we can describe its entire shape with just two numbers, the mean, which is the center point, the most likely outcome, and the variance, which tells you how spread out all the other possibilities are. Is it a wide, flat bell or a tall, skinny one?
And here's why that really matters. For any variable that follows a normal distribution, we know that about 68% of all the outcomes are going to fall within one standard deviation, which is just a measure of that spread from the average, and about 95% will fall within two. Having that consistent predictability, that's the absolute bedrock of how we manage risk today.
But, and this is a big but, the bell curve isn't perfect. For all its power in modeling returns, it has one major critical flaw when we try to use it for asset prices. So what do you think that flaw is? The shape itself kind of gives you a hint.
So here's the deal. The tails of the bell curve stretch out forever in both directions, which means the model technically allows for negative values. But have you ever seen a stock with a negative price? No way. A stock price can't go below zero. So the solution is its cousin, the lognormal distribution. It's brilliant. It starts at zero, so you can't have negative prices. And then it has this long tail stretching out to the right, which perfectly captures the reality of an investment. Your loss is capped at what you put in, but your potential gain is, theoretically, unlimited.
And this is where it all clicks together. It's really elegant. There's this powerful connection. If you assume that the returns on a stock follow that normal bell curve distribution, it follows mathematically that the stock's future price has to follow a log normal distribution.
This beautiful link is exactly why the lognormal is a cornerstone of groundbreaking models like the Black-Scholes option pricing formula.
Okay, let's take a quick breather. We've defined our challenge, and we've assembled our key tools, the binomial, the normal, and the lognormal distributions. Now for the really fun part. Let's look at the master application, where we put all of these tools to work to simulate thousands of possible futures.
So how do we do that? With something called a Monte Carlo simulation. The best way to think about it is like a financial laboratory. Instead of just trying to calculate one single expected outcome, you basically tell your computer, hey, here are the rules of the game, using the probability distributions for all your key variables. Then you tell it to run your scenario thousands or even millions of times.
The process itself is like this powerful loop. First, you set it up. You feed it those distributions we've been talking about. Then the computer just goes to town, generating thousands of random outcomes based on those rules. And it calculates a final result for every single one. So in the end, you don't just get one single answer. You get a full distribution of possibilities, this rich, detailed map of what could happen, which gives you a much, much better picture of risk and reward.
And trust me, this isn't just some academic exercise. This stuff is used everywhere in modern finance. It's used to put a price on really complex derivatives that don't have a simple formula. It's used to calculate a firm's value at risk, basically a measure of the most they could expect to lose on a really bad day. And it helps huge pension funds figure out how to meet their promises decades from now. It is an absolutely indispensable tool.
So we have this incredible toolkit, right? We have distributions that give us a language to describe uncertainty, and we have simulations that let us explore thousands of futures. But that leaves us with the big question, doesn't it? Just because we have these powerful tools to model risk, does that mean we've actually mastered it? The truth is, these tools give us an amazing framework for thinking about the future, but they're only as good as the assumptions we put into them. And the future, well, it always holds surprises that no model can perfectly predict. And that right there is what keeps the world of investing so endlessly challenging.